There we go. Good morning, and thank you very much for coming to listen to what we've got to say today. I was just having a quick look at my presentation last night, and I thought maybe I'm being a bit too pessimistic, actually. I think sometimes, maybe myself, but maybe just this, also the region, we can be accused of this, in terms of we tend to have a bit of an engineering focus sometimes. I was just mentioning to Julie this morning, where we tend to worry about the crack that might make the bridge fall down, and we concentrate on the negatives and look at the challenges in that kind of way. And whilst I want the engineers to still concentrate on where the crack might appear in the bridge, I think we also need to balance that in terms of the context in which we're coming from. So whilst I'm looking at the challenges here in some way, the context in which we're coming from is still very positive in Australia. I mean, if you want to be anywhere in the world right now, well, you still want to be, Australia's a pretty good place to be. You don't really want to be facing the challenges that North America still has. I mean, they're slowly improving, but they've still got some dramatic challenges. You don't really want to be in Europe and facing the challenges and the potential third recessions and those kind of things that they're facing over there. You really want to have access to the largest growing economies in the world, in Asia, and you want to be in a westernised democratic country in Australia. So I think it's a pretty fabulous place to be right now. And so whilst things are changing and we have some difficulties going forward, you've got to keep that in context. And again, the Hunter within the Australian context is still a pretty good place to be as well. I'll talk about some longer term trends today because I wanted to talk about the challenge of transition from a longer term and a short term perspective. But one of the joys about being in this region is that we're pretty rare Australia-wide, actually. We're pretty rare in terms of we're not a big city. And so we don't have that concentration of services and metropolitan issues and so on. But we're not a regional rural area either in terms of, it's very remote or very specialised in certain particular industries, etc. We're very fortunate in terms of having a balance of both, and we're one of the few regions that has that. So the diversification of the economy in that respect is a real strength that we've talked about before, but it's a valuable thing to have, and it's a good place to be when you're going through change. We're fortunate when the resources cycle came through that we had access to the resources sector. We had resources close to us rather than up in northwest Australia. And therefore we managed to ride that wave. We haven't ridden it as much as West Australia and North Queensland, etc., and the Northern Territory have ridden it, but we definitely caught that and benefited, as most people know, over the past 10 years. But at the same time, we do have other sectors. We're not entirely dependent on that, and therefore as things wax and wane, hopefully what we'll do is we'll catch the next thing that comes through. I'll talk about that in a little bit more detail. So as I say, I mean, the focus, the theme that I wanted to present to you today is really the challenge of transition as we transition out of the resources sector boom that we've been going through. So you can see this in two ways. You can see it in a short-term way, in a cyclical sense, and I'll go through that in a moment. But you can also see it in a longer-term sense of the phases that we've been going through since the recession in the early 90s, and even before that, really, the phases that have been driving the long economic expansion that we've had. And if you look at it in that context, there's a question in terms of, okay, well, what's going to drive us now? And I don't necessarily have the answer for that one. I think there's a bit of a step between the potential and the opportunities that are there and the answer in terms of what's really going to drive Australia and what's going to drive this region in terms of our economic growth. But it's a question worth asking, and it's something that hopefully we need to address and tackle. So anyway, I'll jump straight into that in terms of we might as well look at structural change. This is a bit of a bright chart for this time in the morning, but forgive me, but it's the only chart I could find that could try and explain the last 30, 40 years in one chart for you. This presents the employment profile within the region by sector, going back to the 70s. The great thing about the foundation is we can rummage around and dig out papers and stuff from the 70s that give us data over a long period of time so we can see what's going on. So you can see here the different sectors in terms of agriculture, mining, manufacturing, utilities, construction. Retail wholesale is the dark blue, and there's a bit of lack of clarity there, I'm sorry about that. And other tertiary services is the purple here. So that includes everything from transport to education to professional services, etc. And some of the points I wanted to make in terms of the transition. First of all, manufacturing. We've got a bit of a manufacturing theme today with the ARG presenting, so I thought I'd highlight this one first. Obviously, the 70s and 80s was a story of tariff reduction, is a question of deregulation, opening up the economy to the overseas markets, etc. And what happened there is we had a crunch in manufacturing employment. There's a different thing, and the key point I wanted to make here is that when employment goes down and gets crunched, it doesn't necessarily mean that economic output from that particular sector is going. In fact, manufacturing in terms of its labour base may be declining or holding steady. But you can still have economic output actually growing or holding steady in that phase as well because of improved productivity over time, improved capital intensity, and we know that's actually the case with manufacturing. But in the 70s and 80s, what we did have there was a crunch in the employment profile within the region. And what we did have, of course, is a huge expansion in the 80s of services as the market economy deregulated, both in terms of producer, business services, finance, and consumer services. It expanded very rapidly. So that was the 70s, 80s story. That was what was driving as we deregulated, opened up the economy. We had a huge expansion on that side of the equation, and that's what drove the Australian economy, and that's what drove the regional economy. Moving into the 90s, of course, part of the deregulation we had in the 80s was in finance. So finance, where you used to go to the bank and they used to have a kind of quasi-authority role about how much money they're prepared to give you and are you wearing a nice suit and so on and so forth. That, of course, changed to a market equation where, okay, well, can we afford to lend this person and give them a mortgage? And if they can't pay it back, how much is it going to cost us to get hold of their property? And it became a commercial equation fundamentally. And what that meant is that people borrowed and borrowed dramatically. In the private sector, and that happened in the corporate world, and it happened on household budgets as well. And so what we saw through that phase was basically huge borrowing, and that flowed massively into housing. That's where we had the long housing boom from the mid-90s up to about 2003, and we also had a massive expansion in retail. So you can see, well, that previous one there, you can see this in the numbers in terms of retail, its contribution in terms of those employed in retail expanding quite dramatically, retail and wholesale. And housing, it doesn't show so much in terms of the construction side of things, but then construction includes commercial and residential construction, and so you've got a mixture there of the slowdown in the commercial sector following the late 80s expansion, and the housing sector picking up. So that's sort of even keel, but you can see it in retail in terms of the massive expansion there. What's interesting in terms of the latest data, in terms of the 2011 data, is how much retail is coming back again. As we've been through the resources cycle, one of the really positive things we've been doing as a nation and within the region is paying off that debt binge that we had earlier, the debt binge that boosted the economy in terms of housing and retail. But what we've been doing is not putting some of this away effectively and paying down that debt, which is a good thing in terms of putting us on a stronger basis going forward. But what that has meant, along with some other structural factors like the development of online retail and the amount of money that people direct there, the fact that people are going overseas and spending their money there, these kind of things are also crunching retail, and that has meant that sector's come back. But of course, since 2003, post the retail housing driver behind the regional economy and the national economy fundamentally, we've had the resources boom. Now, this is employment in the mining sector. It doesn't look very dramatic in terms of what's been going on here. I mean, it's a relatively small base in terms of, increased over this 10-year period from about 3% to about 5%, and we know it's up to about 6-7% now. But mining is not a labour-intensive industry. It's a capital-intensive industry, and it also has huge flow-ons in terms of economic output. So whilst this change is small from an employment point of view, its flow-on in terms of the economic output impact within the region and the value add it contributes is much more substantial than that. So that's what we've had, basically. So we've had a shift from the 70s in terms of tariff deregulation and the driver of that coming through in terms of services for about 10 years. I mean, being a bit black and white here in terms of 70s, 80s, of course, it's not quite that clear. There's a flow-on and overflow of these kind of things. But as a general rule, that was what was really driving the economy through that phase, and commercial construction was pretty strong in the late 80s as well. In the 90s, that shifted to the borrowing binge, and what was driving us there, and that was retail and housing really drove the economy for about 10 years there, up to about 2003. And ironically, it was the resources cycle and concern with the resources cycle that started us increasing interest rates, which brought the end of the housing cycle and brought it to a head earlier, which meant that we didn't go into a cliff in a US kind of way, which is a fortunate thing that happened at the time. And of course, since then, we've been having the resources cycle, which is a super cycle fundamentally. Resources cycle usually lasts about 7 years, but this is one bigger than that. We've had a more expansive cycle than that. And we've had huge capital investment coming off the back of that. But as we know, that's coming to an end now. Commodity prices have slowed down. There's additional supply. The cycle is a cycle. So new supply comes on in the global market. Fundamentally, prices have fallen away mainly because of demand concerns in the short term. But at the same time, we have additional supply coming on in the market because of all the capital investment that's been going on globally as well as locally. And that's going to keep a lid on the price growth that can come back going forward. So the question is, what next? I don't have an answer here, but it does give you an illustration of we've had these drivers coming through, and therefore there is a bit of a challenge in terms of this transition of what's going to come. We can change monetary policy settings, and we can change fiscal policy settings, and the world will evolve to adjust, and we'll have new drivers coming through. But what is going to drive us from a long-term point of view in going into the next phase, and how do we make that transition? It's not going to be beautifully smooth. So looking in the short term, talking about the business cycle and where we're at through that particular phase, just take stock again in terms of total employment and where we're at there. So, we peaked here in interest rates. We stimulated the economy a little bit with the concerns with the GFC. It reacted in terms of interest rate. We retracted those interest rate cuts, and it stepped up again. We started implementing interest rate cuts, and what has happened is it's sort of leveled out. We've had a managed slowdown, as we should say, from a monetary policy point of view. So the labour market, though, as I say, in this longer-term context, we've still got record pretty high employment levels. I mean, it's fallen away a little bit, but from a long-term point of view, we've been growing in terms of, over this 10-year period, this is growth of about 2.5% in terms of employment compound over 10 years, year on year. And if you think that the population is only growing about 1%, it gives you an illustration of how strong the economy has been through this particular sector. Of course, this particular phase, driven by fundamentally the resources boom that we've been going through. Unemployment, if you think about that, I didn't put the chart up here for the sake of it, but it's around 4.9%, 5%, something like that, about even with the state at the moment. I mean, that's a good labour market. That's a solid labour market. There's nothing wrong with that. Participation rates is in about 61%, somewhere between 61 and 62%. It's been flatlining for a while, which means that people aren't particularly negative about the market the labour market right now. Looking forward, though, I mean, this gives you a sense of job advertisements, which is a leading indicator by about 3 to 6 months of where the labour market is probably going to go. The black lines are annualised change in Australia, and the reds, the hunter. You see here we held out for a bit longer than Australia because of the resources side and our strength locally. But we have followed that path down. And so fundamentally in the short term, this looks very dramatic. It's not the end of the world, but it does suggest that the labour market is softening, and the regional economy, as we know, is going into a softer phase, as illustrated by the labour market. One of the reasons, of course, is they're just touching on the resources cycle. So this chart here is thermal coal prices. Gives you a sense of, okay, this is where everybody said, let's invest massively in thermal coal. This is where it all came off the cliff, and then it was like, oh no, well, instead of putting them on hold, maybe we will proceed. And then with them falling away again, that's where the next wave of capital investment has been put on hold for an extended period until the context changes again. What we're seeing there is it looks like there's a little bit of stabilisation going on in global prices for thermal coal. That isn't going to change the equation in terms of new things fundamentally being kicked off again from a capital investment point of view of new mines. But what it does suggest is that things are stabilising, but the focus in mining really now at the moment is really, okay, well, how do we get profit and make the most of the capital investment we put there, particularly by focusing on cost management and cost control, really. That is really where the mining sector is at right now. It's all about cost control, and it's all about how do we make the most of it and get our margins out and our surplus and our return on equity invested by working the capital we've got there, and particularly working the costs. So, I mean, if you think of previously the story, 5 years ago, is how quickly can we make these things happen, secure employees, secure positions, just make it happen, get things happening. And of course that builds up some inefficient practices and inefficient cost structures and so on, and now they're working back the other way and trying to improve their margins by crunching the cost side of things, which means they're not looking at an expansionary point of view. That phase is particularly gone, that's gone for the moment. So if the resources sector is coming off, the problem is usually, and I won't elaborate too much on this because I'm sure Julia will touch on it, but really what we traditionally have in Australia is an association between the currency, and this is the trade weighted index of the Australian dollar, so it's the Australian dollar as weighted against who we trade with, so you get a fair representation of what it means against who we're trading with. And usually there's a close association with commodity prices. So commodity prices come off, the currency comes off, and what that is a natural stabiliser. So where we're not having a boom when we're having a boom in resources, it's higher, which helps slow down other sectors within the economy. When the economy is commodities come off and that side of the equation slows down, traditionally currency would slow down, and that would mean that other sectors get a bit of breathing space to expand. That's not happening at the moment. That's not happening for strange reasons. And the strange reason in this respect is partly related to the global financial crisis and capital inflows. We're seen as a great place, as I was saying earlier, to be in the world right now, and therefore people want a piece of the action. And so you've got sovereign funds and various other people divesting, broadening their portfolio to include much more Australian assets and Australian currency, and that means that it's holding the dollar high. This is a bit of a problem, though, in terms of that transition to the other sectors that really could do with that breathing space to enable the expansion. As I say, I won't go on to any more about that because I'm sure Julie will probably touch on it. So that's partly the reason why business confidence is down. Our latest December figure for business confidence in the hunter economy is still pretty soft, really. Now, there's a bit of a skew here in terms of smaller industries, smaller businesses, and therefore they're a little bit more exposed to the retail and consumer side of things, which has been soft for a while, and housing and those kind of things. So it's probably over-egging it a little bit because we're not exposed to the big, well, it does pick up the big companies, but not to the same extent. They're not weighted accordingly. And so it's probably over-egging it a little bit, but at the same time, it's an illustration of that transition and that confidence of the upturn in other areas isn't coming through yet. And partly that's a dollar story, but partly it's because of the other structural weaknesses in the other sectors that we'll talk about in a moment. Housing. I just wanted to, again, give a bit of exposure in terms of housing. One, because it's a sector I obviously know quite well, but secondly, because it's a big focus for the Reserve Bank. When they're looking to switch out of resources and business investment, they're looking to drive investment in other parts of the economy, and one of the core things they've identified is housing. Housing's been flat for about, well, since the peak. This is a long-term chart, so since 2003, as I was saying, this is the bit where retail and housing was driving the economy. Fell off a cliff there with interest rate rises because of the resources cycle, and it's been flatlining. The hunter has been performing better more recently than some of the other markets, so this is an exaggeration compared to what's been happening necessarily nationally. But what this shows you is prices, median prices for houses, and this is sales volumes. I'm a big one in terms of looking at what's actually turning over, because sales prices can be a bit misleading sometimes in terms of in terms of the momentum. So sales prices, they wouldn't actually give us the December quarter, unfortunately, because they give it to the media, but they wouldn't give it to us, which is a bit strange. But so we think there's a bit more momentum there. There's a bit of life in housing right now. There's a flicker of hope there, particularly in sales volumes. Sales volumes are picking up, which suggests that there is a bit of momentum coming through there. And this is exactly what the Reserve Bank will be looking for. When we look at our sentiment series, we ask people whether they think it's a good time to buy various major bulky goods, be it a car, a holiday, or these kind of things, furniture and so on and so forth. And one of them we ask about is housing, whether they think it's a good time to buy in the market. As you can see here, this was the global financial crisis where interest rates were cut quite dramatically, and then people thought, yeah, now's quite a good time. We had a bit of reaction in the housing market off the back of that. Then those cuts were retracted because they didn't want to put more stimulation in post-global financial crisis, and people fell away from the market a little bit. And as you see now with the recent cuts, people are starting to think now's a better time to get back into the market. So about 2/3 of people that we surveyed, 2/3 of the hunter residents effectively, think that now's not a bad time to get into the market. We start looking at first home buyers in particular, and first home buyer age group is not 20 anymore, of course. The first home buyer, median first home buyer is about 30 these days, 29, 30. You look at that particular age category, what you see is that they are even more volatile respondents to basically the interest rate context, which is not a big surprise if you think about it. So basically interest rate cuts, they come back in a bigger way, they fall away dramatically. Now, first-home buyers are obviously very important because they're the people that provide the liquidity to the market. When they come into the market, first-home buyers and investors, but when first-home buyers come into the market, they free up the next round of people to buy the subsequent property and so on and so forth. So therefore, that is what spills over into renovations, that's what spills over into the new construction market, and that's what really drives economic activity from there. So as you see, first-home buyers are coming back more dramatically with the current interest rate context. And hopefully that confidence will flow through into the market a little bit more. This is a series that we've put up before. This is an index we derive for first-home buyers in terms of how affordable is it for them to actually get into the market. So this is basically a relationship between house prices, mortgage rates, which gives you a sense of the repayments that they have to have. It takes account of stamp duties and grants that may disappear or arrive, depending on what the policies are at any particular time for first-home buyers. And it also takes account of their income and performance of income over time. You want to see here when the housing and retail sector took off and drove the economy for about 10 years. This is where we're at in terms of affordability, so it's no big surprise. The reason it got worse was because of price rises and subsequently interest rate rises. That topped out the market there and is bobbling along in a not too fantastic position. global financial crisis cuts made it a bit better. We had a bit of a reaction in the market, but then since then it's been falling away. Now, but at the same time, still relatively high. So this is one of the structural issues. We put in the latest figure. We sort of projected where prices were at and incomes and interest rates. We knew, obviously, where interest rates were the last year. And this is where it's at. It's actually stepped up a little bit. So the point being is that whilst things are looking better in the housing market and we see a bit of a flicker of life there, these structural issues in terms of the housing sector, in terms of affordability, are still not working really in our favour and aren't going to pick it up rapidly overnight. We're not going to see a rapid rebound in housing. You could argue, in a way, that this long-term benchmark of where things are is, now that the mortgage market is deregulated and people have got used to how much they want to borrow, then maybe this is more like a line where people start either spending more and getting into the housing market more on this side of the equation, rather than having to get down to here, where it was when we had the major upturn. Even if you account for that, though, we're still the wrong side. We're still on the worst affordability side of that side of the equation. So we suggest there's probably going to need to be a little bit more stimulation. The housing market will pick up a little bit. We're probably going to need some more stimulation before we see it pick up dramatically enough to really flow into new construction. This is a bit of an ugly chart, I'm afraid, but this is the reality in terms of building approvals. These are building approvals for houses in the region, and just for a background context, we put the New South Wales trend underneath there for you. As you can see, it jumps up and down a little bit, but fundamentally we've been going nowhere for a long time. This is the levels we were at when things were really driving the economy. And as you can see, we're not even, so we really need to be somewhere in between, kicking up to here. And we need more stimulation fundamentally to try and get that happening. And right now in housing, it's not. Retail and consumer side of this, those in those particular sectors within the region have been really struggling. And part of it is just this general pessimism. There's a strong relationship between retail sales and consumer sentiment at the national level. Unfortunately, we can't get regional retail data in a robust way. And so we have to rely that, there's no real reason why that association wouldn't be true locally. But fundamentally, our measures of consumer confidence suggest that people are aware it's, bouncing around a little bit. It's not the end of the world. But at the same time, it's not things are good. People are cautious. And so if you add what's going on in the retail and consumer side that we've touched on before, in terms of people still paying down that debt that they borrowed, the savings levels are still relatively high compared to they were 8 years ago. If you consider that where the dollar is means that everybody is going overseas, and I don't know how many people you know that, but I know who go overseas with one suitcase and come back with about 3 stuffed with things that they bought. But basically all that expenditure that's going overseas means that they're not spending it locally. It's not going into the local shops, and therefore that is what's keeping the retail sector weak. Saving, spending overseas, and just this general caution as well. And the other thing with the dollar, of course, is online sales. If you're buying something from the US online, it's relatively cheap to do it right now. And of course, being an economist, it's a balanced thing. As things get cheaper or relatively cheaper, more people are going to spend their money over there. As they get relatively expensive, they'll direct it locally again. But right now, with the dollar being where it's at, it's not really assisting this cause. The other side of the equation, though, is this is in terms of trade. So this is gives you a sense of this is what's partly been driving the economy over the past 10 years. Record levels here, as you can see from a historical point of view. This is the relationship between how much money we get for the things we export versus the cost of the things that we import, and therefore the things that we export bring money into the economy that washes around, and there's more of it around, and most obviously through resource wages in this particular region, for example. And then the imports in terms of plasma screens, most notably, of course, Glenn Stevens gave you a good example of how every boatload of iron ore that used to get us 2,000 plasma screens, and then that changed with this equation to getting us 20,000 plasma screens, and because of that relationship. What we're seeing now is that actually falling away. With commodity prices falling away, that terms of trade stimulation is not going to be as great. And we can see that even on the ground here locally, the extent to which people don't have the contract that they had in terms of lead up of new capital investment projects and resources, that's not available. That means there's less jobs of paying that kind of money in the economy, which means it's not flowing through and stimulating the regional economy quite as much. So from a slowdown point of view, that's not really assisting the retail consumer side of the equation either. But having said that, it's still pretty high. And so this is one of the things where you can be too pessimistic and worry about the cracks a little bit too much. There's still quite a lot of stimulation in terms of economy, the income coming into the national economy, and we're taking our share of that, and therefore, it's not the end of the world, and that's why our unemployment rate is still around 5%. So it's declining. It's not really going to assist it's not really assisting the direction of consumer sectors. but at the same time it's still quite stimulatory. So what will pick up, what or who will pick up the ball and run then going forward? So as we see the super cycle of resources retreating, the question is what's coming forward now? So as I say, we've got these are the challenges that I'm talking about, a transition. So from the consumption sector side of things, we're still paying back that debt right now. People are still wary, and the more wary they are about international situations, the more debt they repay rather than putting it to local shops. Online retail, as I was saying, the fact that insurance and rates, if you can cut mortgage rates and give people cash in that kind of way, but if insurance costs and rates are going up accordingly, and it just basically is a transfer of that income from one side to the other, it doesn't give people more money to stimulate the economy. So we're definitely losing, the retail consumption side is definitely losing out because of that. And the overseas expenditure, as I say, is also a challenge. And those things are exacerbated by the high Australian dollar. It would be improved if the dollar was coming off, but it's not right now. Housing, we're seeing a flicker of life, which is showing a bit of optimism. The potential people to, their sentiment in terms of getting back into the market is improving, but we're fighting against this affordability thing, which is a structural problem that we got from the last, the previous housing boom that still exists. Commercial construction, tenant demand is still soft nationally, and it's still soft locally. Fundamentally, that you get somebody to sign up for 10,000 square metres of space. It's been a long while for that kind of thing. And if you're trying to get development finance for construction, it's still, I don't know whether people are trying locally, but it's very hard. And that really is a legacy of the global financial crisis and people's conservatism about putting money out there and whether they want to put it in a regional economy for something where demand is relatively soft. Tourism, you think of a sector like that, you don't think of it as one that's really struggling right now, and I don't think it's necessarily one that's really in the end of the world, but what we're missing is really the upturn. So we're seeing some really good stories coming out of tourism in terms of the number of Chinese tourists, despite where the dollar is actually picking up, and some of the Asian markets, the emerging Asian markets are picking up, which is a really good thing. But at the same time, you think of where it would be if the dollar had actually dropped away, and it's more important for Europe and the US and those kind of visitations. That visitation generally from overseas is held surprisingly steady given where the where the Australian dollar is. But if it was lower, it would be an even greater stimulus. And so we're really missing out on the upside of it coming through. And it's particularly annoying given that the dollar, in a way, is an artificial one, not of our construct, because of these international capital flows and demand for the currency. So it's not really helping the real economy. So, and likewise for manufacturing, obviously, if you're in tradable sectors, it's a cost disadvantage for you because you're competing against imports that are relatively low cost just because of the dollar, and you're trying to sell into export markets where the dollar is making, even if you're being productive and efficient, making you relatively uncompetitive. Now, obviously, that varies by sector and all the rest of it, but if you look at it in a portfolio sense, the dollar's a pain, a real pain. Well, more than that, it's a serious issue. So, in terms of making this transition, I'm throwing up some negatives here of what hurdles we've got to get over to try and get these other sectors to come to the table. But we do have a bit of leeway. We still have some capex in the resources sector that was committed to, that's still got to roll out. ARTC, for example, in terms of the rail logistics for the coal line, has still got a long project pipeline there that's still got to happen. It's still happening now, and it's still got to happen going for the next couple of years. And as I say, the terms of trade is still quite high, so we're still getting the stimulation washing around in the national economy and washing around the regional economy. That's still giving us, keeping the economy ticking over. So it gives us a bit of time to make some of these transitions, to get some of the other sectors to contribute more substantially, but we still have to make that transition. From a positive point of view, I didn't want it to be too focused on the challenges. There are some real positives for us in terms of where we are in the world. Obviously, the Asian centre is there's a lot of white papers that are boring people, I'm sure, but in reality, it's not just about mineral demand. It is a growing economy. China, for example, I heard the other day was, and Julian, no doubt, will touch on it a little bit more, is now the largest market for high-quality goods in the world, luxury goods. So the Louis Vuitton elements, those kind of shops, bigger than the US, bigger than Europe now, is the single largest retail expenditure area in that particular side of the equation. So their demand for education, their demand for services, their demand for a range of other things, as we say with tourism, we already see it coming through Chinese tourist numbers. Energy efficiency, energy is coming on globally, but there's still going to be a big issue. We still have an ageing population and a healthcare, a government sector that doesn't have more money to spend and isn't going to have more money to spend over the next 10 years. Still an area of potential change dramatically, which will create opportunities. Digital economy, obviously it's transforming retail, it's transforming media. It's going to transform other sectors. It's just a question of how is it going to deconstruct it and what's the new one going to look like? What role do we play in that? I don't know. So these are all opportunities, really. And of course, there are unknowns. We don't know what's going to happen. I mean, Facebook, which everybody takes for granted as a kind of mature, boring thing, wasn't around 10 years ago. And who knows what's going to happen in the next 10 years. But the joy is of having a diversified economy, as I say, is that hopefully what we will do is we have some exposure to whatever element is maybe coming through, and we can jump on that and ride that particular wave. But what we can't get around and away from really is that we've had a wonderful time, really, a bit of a dream run with the resources sector. It's provided a huge stimulation to the national economy and to the regional economy. And whilst we've worked that and made the most of it, which is a good thing, those challenges are changing and evolving, and we need to be. The transition is not going to happen readily, and it's not going to be an easier ride over the next 10 years. It doesn't mean to say that we can't do it, and settings won't enable these other sectors to come through, but it's just not going to be as great a ride as it was the past 10 years. Just briefly then, before I end, I just wanted to give, with our fellow speaker here, I just wanted to touch on manufacturing within the region and just give a sense of what is manufacturing in the region, basically from the census data that we got out to try and came out last year, to give a bit of exposure to what it is. And that'll hopefully give a bit of context to what our next speaker is going to talk about. Know your manufacturing sector. So this is manufacturing, but broken down into the second digit layer in terms of what we actually do within the region, and this is the employment numbers within the Hunter in the particular sectors. So we have some major activities, obviously. Primary metal and metal product, that's your aluminium guys and so on. Machinery and equipment and food product, which is a good one because demand from Asia for food is going to go dramatically over the next 10, 20 years, so any exposure to that is a good thing. Those are the major three. Transport equipment, manufacturing, loose ends, you can't really tell what that is, but fabricated metal product, and then you're getting into chemicals and some of the other smaller elements there. But those are the key drivers. But otherwise, we have some other, diversified elements to the regional economy as well. Look at how it's changed. Oh, sorry, where first? Just thought I'd check a map up there for breaking it down. You sort of know this intuitively in a way, but I thought we'd have a look at it just to check. Where is it? Well, it's where the industrial zoned areas are, funnily enough, of course. So this is Tomago and the people who work in that particular part of the world, and Hexham and around there. Steel City and that kind of aspect around there is the concentration around there. And this is Cardiff in Lake Macquarie and the industrial zone and contribution around there. Obviously, there's a bit around Rutherford out the back of Maitland there, particularly growing with the resources sector because the feed into the resources sector has been really strong from there. And this, of course, was just before hydro aluminium went into mothballs. So this will actually go down in the next census, I suspect. But and otherwise we've got distribution of things around Singleton and in Dudley and everywhere else, and odds and sods in industrial parks around the place. So that's roughly where the core of the manufacturing workforce are. This is where they're employed, by the way, not where they reside. This is where the employment base is. If we look at change over the past 5 years, this is what's held us in relatively good stead in manufacturing. These are the guys that have been really struggling, and these are the guys who are either exposed to the high Australian dollar or feed typically into construction activity, which has been very weak. So you've got primary metal. Oh, well, actually, I'd probably talk about the positive first. Let's talk about the positive first. So these are the guys who are feeding into the resources sector, fundamentally. So you've got machinery and equipment, transport equipment growing very dramatically over this period. Food product growing, which, as I say, is not obviously related to resources, but it is a good story. And that's what's been holding us in relatively good stead is the flow-on effects from resources demand into the manufacturing side of the regional economy. On the other side, as I say, the guys exposed to the high Australian dollar and construction, these are the guys who have been weaker. So this balance basically has been holding us in reasonable stead. Now you'll actually notice if you get to take the publication on the way out, there's one deliberate mistake on the third page where it says that manufacturing declined within the region. And then one of my colleagues, as soon as it had gone to the printer, found that was a mistake. So it actually increased by 1% over this particular period. But more recently, generally, manufacturing has come back. So basically, we've been getting away with it because of our feeding into the resources sector, and manufacturing is really benefiting from the flow-on from that side of the equation. But HunterNet put out a survey of their members the other day, which showed that the contract side of that work has really plummeted. And some of those guys are just, that work is not coming from, which is no big surprise, of course, because the capital flow is coming to an end, and that lead-in work is disappearing. And so the other thing to remember about the resources sector is this expansion that we're having and this increase in capability that's coming, it doesn't disappear. We still have the operational delivery of the mining and the goods and the commodities and the port and the logistics and everything that goes with it will hold us in good stead going forward and underpin activity for a long, 20, 30 years for some of that capital investment. But what we're not having, of course, is the next wave of capital investment, the new things that are being built, and that's where we're seeing the slowdown. So I just wanted to touch on the manufacturing debate and set the stall then out in terms of the context for here, because it's an illustration in a way of the challenges that we're making of the transition in other sectors as well. So we're seeing a stall in resources CapEx, which is basically was providing a lifeline for manufacturing in the region for a while, and that's coming to an end. The fact that the Australian dollar is not lowering with the usual commodity cycle is a real challenge. It puts even greater pressure on the trade exposed side of manufacturing. And that raises the debate of, do we want to sacrifice diversity? If we just have a laissez-faire economy, then potentially what we'll see is manufacturing get crunched further. And from an efficiency point of view, you could say, okay, well, servicing mining or servicing the Asian economy's demand for services, etc., is where you want to be placing your resources and your equity. But to the extent to which that's hollowing out the economy to some extent, then we are sacrificing diversity either nationally, this is a national debate effectively, but you see it played out within the region very much as well. But if you say, okay, well, we want to defend industries, and this is most obviously, you'll see it most obviously with the car industry. This is where the real debate is in Melbourne and Adelaide, of course. It's a huge issue. And so what they're doing is you're seeing a lot of government subsidies going in to sustain them. They're saying they want another round of subsidy to try and make things competitive and to keep the industry going. And to the extent to which co-investment is a good thing, of the global corporates putting in money and government assisting with that in a joint venture to achieve an outcome, then that's fine. But at what stage does that become basically like the 70s where you're protecting it? It's part of the debate that we've got to have around manufacturing. Of course, fundamentally, manufacturing is not going to go away. I mean, it's still a big part of the economy. It's one of the biggest sectors we've got. And as I say, the story of manufacturing has been really one of productivity over the years of greater and greater capital investment, greater and greater efficiency of returns off the assets that they have in that sector. And productivity is really going to be the answer. Even if the dollar stays where it is and doesn't go anywhere, we can just sit there and wallow around, but reality productivity is really going to drive that story. And to the extent to which we can drive and survive and be successful in manufacturing, and then the dollar comes off, we'll be in an even better situation. So productivity and innovation are critical components for the future of manufacturing nationally and within this region. I'm not going to go on about that anymore because I think we'll talk about that as part of the Hunter Central Coast Innovation Festival. The next breakfast in May will be part of that festival, and we'll present some innovation information and material then. Thank you.